As we're almost at the end of tax return filing season, I thought I'd talk this week about something that I've been helping the personal tax team with, which is a client that they've got with shares in a SIP. So share incentive plans are a form of share incentivization. Typically you see these quite a lot with bigger firms, people like Next, I think Curry still do one. So there's lots of PLCs will do SIPs because they meet the conditions. And so you see some fairly high earning individuals with tax returns requiring disclosures for SIPs. So the way a share incentive plan works is a trust is set up. The trust owns the shares on behalf of the employee. There's a number of ways that the employee can acquire shares within the plan. And it's only when the employee takes the shares out of the trust and takes physical ownership as an individual that there's tax to pay. Generally, if you take any shares out of the plan after more than 5 years, there is no income tax or national insurance. If you take it out within 3 years, there's typically income tax charge, and within 3 to 5 years, there's also an income tax charge. Slightly different depending on the timing, which is why we've generally got to be quite careful, but you should, certainly in bigger companies, have a statement explaining what tax has been deducted at source, because of course PLCs will be readily convertible assets, so PAYE and national insurance should be operated if there is an employment income tax charge. So what's required on a personal tax return? As I say, if they're readily convertible assets in bigger firms and that are PLCs and listed, then the PAYE and national insurance should have already been operated, and we should see that on a pay slip, and it should be reflected in the P60. Once these shares are withdrawn from the plan, other than the income tax charge that could apply, the capital gains tax consequence is the gain is the difference between when the shares are withdrawn to when the shares are sold. So you'll quite often see statements where the shares are withdrawn from the plan, there's an employment income tax charge on withdrawal. If they're subject to PAYE and national insurance, that will be held back. And so they'll sell enough shares immediately to cover the income tax charge. So of course, if they're selling immediately, then there's little or no CGT consequences whatsoever. If they've held them for some time since withdrawing them from the plan, obviously then that's where we might have capital gains tax consequences. So because we've got these different forms of acquiring shares as well, which you could get partnership shares, free shares, matching shares or dividend shares. So dividend shares are where the company declares a dividend on shares that are held in the plan on behalf of the employee, and the employee can elect for those funds to be reinvested in new shares. Free shares, an employee can have up to £3,600 worth of shares per tax year. And then we've got partnership shares and matching shares. So numerous different ways in which an employee can obtain shares within the plan. Whilst they're in the plan, there's no tax consequences. When they're withdrawn from the plan, the employment income tax charge depends on how long they've held the shares in the plan. And then capital gains tax only applies for the difference in value from when they're taken out of the SIP and the shares are eventually sold.
As always, like, comment, share. It lets me know that these videos are well received, and if you have any comments or interpretation of this legislation, really interested to hear everyone's thoughts.